A very good morning to you all. Welcome to the Flow Show, Wednesday, 27th of November. Nice to see you all here. Just a quick heads up for any boys and girls watching us on the other social media platforms and streams. If you want to follow us here on Zoom and comment and be part of the Flow Show here, give us your views and your ideas and what you want to talk about, then you can register for the Zoom platform. Go to ForexAnalytix.com/webinars and you can register there. It's all free, but gives you the opportunity to come and comment and speak to us directly as the show is progressing. So check that one out. In the meantime, we shall crack on. Morning, Kay. How's it going?
Morning, Ryan. Yeah, morning, everybody. It is going, mate. It is going. Yeah, that's about it. We are slowly going into the end of the month and this week, and tomorrow the Yanks have their Thanksgiving day off. So yeah, I mean, it's going well.
Yeah, as I like to call it, it's their practice Christmas.
Yeah.
They need help in eating more food than is physically possible. Where's Bran? He must be stuffing the turkey. There he is. There's Bran. You stuffing your turkey yet, mate? Right. Anyway, yep. So we might have a little bit of a last hurrah today before things go a bit quiet tomorrow. But no doubt the headlines will keep coming in. Right. Let's kick off. The BOJ may be running a massive paper loss on their JGB holdings, considering they're holding over half the market, while rates are going higher. But they're making some money on their ETFs. Their unrealized gains from ETFs was stood at 33.1 trillion yen. Probably a small drop in the ocean compared to the other side and the JGBs. Going to look at a bit of data that we had overnight. Starting in Australia, we had some CPI data, their monthly numbers coming out. Their weighted mean CPI, this is almost like a headline CPI number for October, came in at 2.1%, down from the 2.5 expected, unchanged though over last month. They got another number, a core trimmed mean, which is, as I say, a bit more of a core number. That went up, though, to 3.5% from 3.2% prior. So still looking very sticky inflation-wise over there in Australia, which will keep the RBA in their current stance of non-dovish. Meanwhile, over at the RBNZ, they cut their rates 50 pips as expected, rate now at 4.25%. What they did do, though, was up their CPI forecast for next year. They see CPI by December 2025 at 2.4% versus 2.3% previously. Not a huge uplift, but it's not going the way they would like it anyway. They say global economic growth will remain subdued in the near term. They say that economic activity is subdued in New Zealand, but that economic growth is expected to recover over 2025. They do expect to lower the OCR rate, or the OCR, further early next year. In the minutes, they said if economic conditions continue to evolve as predicted, the committee expects to be able to lower the official cash rate further early next year. Governor Orr adding to that as well when he came up to the mic. Said confident domestic inflation pressures will continue to ease. Says it's a misnomer that our predictions show a slower pace of cuts, and that's referring to their OCR forecasts. The market tends to misunderstand what they're there for and take it as where they expect or how rate cuts or monetary policy will evolve. But a lot of those came down a bit as well. Adding to the continued cuts, says projections are consistent with another 50 basis point cut in Feb, depending on activity. And then he got into some proper central banker speak. He said, we did not discuss cutting by 75 basis points, but then added that they discussed limitedly 25 or 75 basis points. Work that one out. They expect to be to neutral at around or by the end of 2025, and neutral is somewhere between 2.5 to 3.5%. So given where rates are now, that's further cuts of between 75 and 175 basis points from here. Now, the Kiwi bounced a bit after that. Bit of, buy rumor, sell factor, whatever way you look at it. There's no real repricing to be done amongst this. The market knows where the RBNZ are going. They know how quickly they're likely to get there. They know where they're going to stop, over what period. There is nothing more dovish to come from the RBNZ as things stand now. Obviously, if the economy craps out, gets worse, then they can cut more, cut faster, cut whatever. It's not been a huge move in the Kiwi, just a bit of reflection that there's no further dovishness to come from the RBNZ. Kay, anything out of that lot, and maybe the BOJ's paper profits on their ETFs?
Yeah, paper. I mean, it's just good to fill the media's papers. Forget about all those paper losses and profits. They don't have to buy or sell to cover profits or losses. So I mean, forget about all that. Yeah, the RBNZ, typical sell the rumor, buy the fact. Market taking profits. Yeah, but there's not too much more to be said. Bond market repricing a little bit. Well, not repricing, but rebalancing their books once they got the fact of the RBNZ cutting, and that's it. Yeah, as we said, we are seeing this bounce in the Kiwi dollar, which we will likely look at in a few minutes, but. Still not out of the woods there. Still not really out of the woods. There is already the 59, the figure 59.05 is already a bit of a hurdle. As long as it stays below, we can hardly call this very bullish. But there's a start to everything, and it does seem that we found some reasonable ground to find a bit of an intermediate bottom there on the Kiwi, and then we will see what month end and potentially even year end flows will start to bring. But that's it. Yeah, I think or leaving the door open. It looks as if they and we know that OR is a bit of a specialist of trying to do things a little different than others, and over time potentially having a bit of 180 degrees views on things. So I'm not ruling out that the next, if the economy doesn't fall out of bed, he all of a sudden says, well, actually we're not going to do 50s but 25s. But yeah, they like to do things perhaps a bit different, so it's not a huge surprise. It is interesting that he is now mentioning the neutral rate, which is, let's call it, kind of logic, and will be somewhere in the region of what the others may do as well. So in that respect, it's rather similar to other central banks, but they're getting there in a different way.
Yeah, absolutely. Yeah, I mean, it's a bit of a wide marker, 100 BPs between 2.5 and 3.5% for their neutral. Yeah, they will mechanically slow down. I think if they see 3.5 as a neutral level and they're expecting to cut 50 pips in Feb, that only leaves them 25 pips to get to that 3.5 level. So I suspect that if they do a 50 in Feb, then they will then switch to 25s perhaps.
Or even pause mode,
Yeah, maybe pause as well, just to let it play a bit of catch up, because that's one thing they don't really mention, like other central banks, that there's a lag between policy moves and when they see the effects of it. They've just, gone gangbusters ahead, cutting the 50s. So, yeah, I think after the Feb, then there's a greater chance they might pause or they at least go to 25s, depending on how the economy is going. Now, it's going to be important to watch what happens with the RBNZ, because they are ahead of the pack in terms of potentially getting down to a neutral level and how they react there. So it might be taken as a bit of a blueprint for what the others may do. It will be a blueprint for those of you trading to see what happens when we get to an end of a cut cycle. or towards the end of the cut cycle, because all the banks are heading that way, and it will happen in different speeds, different moments. But then you'll start to see the end of the dovish slant in the market, unless obviously the data keeps going south. Then you find out whether central banks are going to have to chase their economies lower, take rates below their neutral levels, make them more expansionary rather than neutral, and that will become the trade we will be playing next year, no doubt. Anyway, moving on, we had the CPI data out yesterday. This was the retail side of things, coming in a very ugly down 18. It was expected to come in down 14, so not looking good for expected sales in November. I read the report this morning, and it's looking pretty horrific there as well. Retailers expect things to get even worse in December. Now, why is this particularly bad? Because November and December are obviously the biggest, or can be the biggest, retail months of the year. All the sales, holidays, Christmas, whatever. So the fact that there is a very sour look to these sales doesn't bode well for the numbers that we may see from the data for the UK. That's going to weigh on the quid. So just keep that in mind, that this one report, and these guys, they're always glass half empty rather than glass half full at the CBI. So it's always a negative looking slant, but it doesn't bode well in terms of that data. So be prepared maybe for some more soggy data to come. Moving on to the BOE. BOE's Peel said he wouldn't want to overstate the budget impact on the CPI data. Says the national insurance rise may have a small positive impact on CPI, and that it will weigh on the labour market at the margin. So a bit of a brush off in what that national insurance tax rise that's been placed on firms at the budget, how that will impact jobs, wages and prices. Over at the ECB, some people say that the PMIs don't really mean much at all. Not for ECB's Kazakhs, who says falling PMIs back more rate cuts. So he doesn't like the look of that data last week. ECB Schnabel, he was a bit of a comment this morning. She says she sees only limited room for further rate cuts, and then adds that the economy is still stagnating, but there's no recession risk. And the ECB shouldn't go accommodative on interest rates. So a bit of a mixed comment there, given what we're seeing in Germany at the moment. Still not seeing any major problems in terms of the economy. Though I beg to differ, looking at the data we've been getting, including this morning's GfK German consumer confidence. I'm not sure if it's on this calendar. Oh, there it is. Coming in at a nice healthy minus 23.3. So you tell me why the ECB shouldn't go accommodative on interest rates. Now, the interesting thing about this story that's been picked up today is that this interview was done 2 days ago, and it was done by Bloomberg, and they decided to sit on it for 2 days before releasing it. So they're up to their old shenanigans. They knew this would be a potentially market moving headline, so they've been messing around with that. What do you make of Schnabel, Kay?
Comparing to German data, a bit surprising, but looking at what she's been saying in the past, maybe less so. It moved the euro a bit this morning, but I think the market is looking at other stuff right now, especially month end, into a pretty liquid US market. I'm not going to read too much behind it. When do we have the ECB, by the way? 12th. Okay, so we still have like 2 weeks to go. Yeah, She may be erring on the cautious side, but perhaps also, I don't know, a bit psychological, because most of the others are now pretty dovish. that she feels the need to calm her colleagues, perhaps mostly a bit. I'm not reading too much more in it. Looking at my position, I would love them all to be hawkish, but no, I mean, I'm not going to read too much in it. We're trading month end right now, and we will see in December what. Oh, or perhaps no, starting tomorrow with the German inflation data. That's going to be more important, I reckon.
Yeah, we get Germany tomorrow, and then the pan-eurozone numbers on Friday. So that will definitely set up the scene for the ECB. But one thing that I'm finding is that the opinions seem to be splitting up a bit more coming into this December meeting. They don't all seem so much on the same page. We've got people like Nagel and Villeroy declaring victory on inflation, but then even Nagel said that the size of a cut may depend on the debt projection. So that insinuates he's open to a 50, and he's one of the big hawks. Others are saying they want to avoid an undershoot of inflation. Just seems the opinions are a bit larger or a bit more diverse than we've had of late, mate.
Yeah, it's strange. They came all relatively well together, and now perhaps some are saying like they need to be a bit more cautious also. Um, I the funny thing is that we haven't heard really from the gal, have we?
She did waffle a bit when you were off.
Yeah, but lately, I
So
mean, not
yeah,
not
nothing
heard
lately.
much, right? She was
Yeah,
hammering the countries for not being fast enough on the fiscal side of things, but she didn't really stick her neck out to anything monetary policy related.
no, that's right. I don't know if she's due up any time. She's only got until only next week, and then they go on lockdown. So maybe we'll see if that pops up on the calendar. Yeah, we'll see. We shall see. Right, coming over to a bit of US data that we had yesterday, just to see what was going on. We've got the house price data out, and nothing really untoward there. There was a bit of a downward shift in some of the prices there, particularly the year-on-year numbers. The FHFA number was unchanged on the year, but saw a decent rise on the month. The S&P K Schiller number, the 20 city number year on year came down 4.6% from 5.2%, so soft there. The national HPI came in at 3.89 from a prior 4.28%. So a little bit of a downshift in house prices that are running at relatively healthy rates. No yellow flags there yet. There might be a yellow flag being unfurled in one of the housing numbers. New home sales missing expectations and coming in with a decent drop to 610,000, a drop of 17.3%. Is October maybe some weather affecting there? Who knows? We'll have to see if it's a one-off or not, or whether that's something that's going to continue and maybe start to be a bit of a drag due to interest rates. We'll keep an eye on that one. We also got a couple more regional numbers, manufacturing numbers. Richmond Fed down 14, so not looking good from that one. Although we did get some other bits and bobs as well, not really important from the Dallas Fed there. We did get the Conference Board consumer confidence number, which was another positive, pip lower than expectations, but a rise over last month, and last month got revised up quite high as well. Within the data, the current conditions number improved as well, 140.9 from 138. Expectations improved as well, 92.3 versus 89.1. And I've spoken about sentiment in the US. If things like sentiment increase, then it can lead to increased activity. Good news for the Fed. 1 year CPI expectations came down to 4.9% from 5.3%. Still running quite hot, but going the way the Fed would like them to go. All in all, decent soft landing numbers once again. Fed's Gall's Beast says it makes sense to slow cuts as the rate approaches neutral. We got the Fed minutes yesterday evening. No real shocks out of that. Some see a pause or faster rate cuts as options, covering all bases there, depending on the incoming data. They have talked about a 5 pip reduction in the reverse repo rate, saying that would just be a technical adjustment. There was Mark pointed out in our chat room that would mean the potentially rate futures or rate markets coming down a bit lower. We've had BOC's Mendes talking, saying he repeats further cuts are likely. The timing, though, and pace depends on the data. CPI below 2% would harm the economy and inflation expectation. So maybe a bit of a warning for further rate cuts if that number comes down too low. Back on the jobs bus, in the UK, headline was out that Vauxhall, one of the car makers here producing electric vehicles, are going to shut their EV plant in Luton, or potentially shut their EV plant in Luton at the cost of maybe 1,100 jobs, although a lot of those were said to be shifted to their other plants. This is a thing going on here in the UK with electric vehicles, and it's something going on in Europe and elsewhere with electric vehicles. We have the government who are going bonkers over their climate crap. There's restrictions on car makers, or limits, whatever you want to call it. They have to target 25% of vehicle sales being electric vehicles. If not, then they're forced to pay a fine. But to avoid that fine, they can go and buy credits off of other firms. So, for example, if another car company is selling 50% as EVs, then someone who's not selling their 25% can go and buy a credit off them. It's all convoluted. Anyway, this is putting a lot of pressure on car makers to hit those EV targets, while the environment for selling EVs is not looking great. This is forcing the new government into one of its first U-turns. They're going to be looking at or bringing forward the consultation about those EV targets in due course. But that's aside from the EV side of things, that's another potential amount of jobs being lost. And as I've been pointing out, these headlines of job losses are picking up markedly. OPEC Plus, they were beginning their waffle on their meetings and what they're going to do about delaying oil production rises. Apparently, they're going to talk about postponing those for several months. Okay, the can kick was supposed to be from now till January, and they'll look at it again. It's looking like they're throwing in the towel a bit on when they're going to be able to do that, given where oil prices are and where demand is at the moment. Russia said they're preparing a response to Ukraine's ATA CMS use in Kursk, according to IFAX. A Kremlin aide said there haven't been any contacts between them and the Trump's team yet, as far as she knows. Maybe there has been, we don't know. The Israel, Lebanon, Hezbollah thing, a ceasefire has been approved by all sides, it seems, though it's probably about as solid as a wet tissue in the wind. So don't be rushing into risk assets just on the back of that headlines. All it's going to take is one stray rocket from one side, or Hezbollah, or whoever side, and it all kicks off again. So for now, there's a truce of sorts in Lebanon. We'll see how long that lasts. Anything else, Kay?
Yeah, a couple of Trump nominations, perhaps. Market doing well. I mean, the retail market. Talking a bit about that. What's his name? Jamieson Greer.
And Hassett.
And the mark, they were saying that perhaps this is a bit dovish dollar because it's not Lighthizer, but we have to know that Greer was already there during Trump version 1, and he was the Lighthizer chief of staff. So that doesn't really change too much. I think Lighthizer will not be too far from Trump's ear anyway. Once he takes the seat. So a couple of other nominations which were perhaps less market moving. But just know that Greer is also very close to what's happening on the tariffs, etc. I don't think that changes a lot. I think the market is perhaps trading other things right now. No, I think for the rest you covered everything and more.
Oh, good. Like it when that happens. Right, let's have a look at what's going on. I'm going to start or stay with the Kiwi dollar. Yeah, we've seen a bit of a bounce. It's not close to turning around this trend, and we're seeing this so much, or in so many dollar pairs at the moment. Doesn't matter what you look at, Aussie dollar, euro dollar. It's the same type of picture. At the worst, we've maybe stopped going down, but these extra lows over this week particularly suggest that we're not out the woods yet. If we can't even get up to have a look at that high there, then again the momentum stays with the bearish side. But for now, we've got a little bit of a bounce. That's helped my Aussie Kiwi short. So I'm keeping an eye on this one because I'm maybe going to be taking a little bit more profit if we go and tap the big figure down at 110. This is one of the reasons why I was looking at shorts, because at some point the RBA is going to be, the RBNZ is going to be, pretty clear on what they're going to do and going to come to the end of their cut cycle eventually, potentially, and then it'll be down to the RBA to turn from their more neutral / hawkish stance to maybe a bit more dovish. So yeah, it's going the right way for the moment. I don't rule out that we don't fall too far, even while I'm short. So I don't think we're going to be going all the way back down to the magnet just yet, unless something changes. That magnet's down at the 108 level, which I can show you quickly in this big wide range. Let's go on to a weekly. In this big wide range that we've got going on here, we've come back time and time again to the magnet. Doesn't mean we're always going to, but what I'm playing as well as the fundamentals and the central banks is this, near 10-year range that's been fairly tight. So I'm happy to technically try shorts up here as well as lean the way that I think the central banks are going to go, and that'll be the RBA potentially, as I say, getting a bit more dovish. But I'm not expecting an outright collapse. Maybe we just dribble lower a bit for a while, but I wouldn't think we're going all the way back down there just yet. I'd like it if we do, but you've got to be objective when trading. I'm going to see if this 110.50 area becomes resistance again, and particularly we've already found that we're getting resistance again in the 111 area. So that will be good in terms of price action for this trade anyway. Another one I'm looking at, and regulars of the show here will know about this one. I'm really getting a bit of FOMO now on this one. We all deal with it. We all get it. I'm getting it. I'm looking to start shorts up into these high levels, maybe 728s up to this 736, 35s area. But I think this is one of the big currencies at risk of Trump. When we find out what tariffs are coming, how hard he's going to go on China. That's why I'm trying to sit on my hands, but I might have to do a little small bit just to scratch that FOMO itch, because if there's big headlines, then we're probably going to be up in the 730s. So I don't want to go too early. Again, the reason I'm looking to trade short on this side is, one, I think all the tariff effects will eventually lead to some sort of negotiation. Two, technically, this is a fairly decent zone up here where we found a bit of a top. It's also where we've seen, it's got a bit wider there. We've also seen this is where the PBOC doesn't like the currency to be. Now, it doesn't mean they can't change their view on how strong or weak they would like to move their currency. Depends on what's going on, but it's been a prior place, and we've already had indication that even up here, it's a little bit too weak for them in their comments. They're still fixed in the 719s, so they're keeping the foot on the brake pedal for now. So several reasons why I want to try short. We'll have to wait and see if it comes in. But yeah, getting a bit of FOMO on that one. I'll have a look at one more, then I'll bang it over to Cayman. Something I want to mention aside from the end of month stuff, we've got a ton of options, pretty much all the way from 104 through to 106. There's a big chunk around 105, some 5 billion. Now, we've talked about this in the chat room. It could be month end related, not in terms of hedging flows and all that sort of stuff, but just we've got a holiday tomorrow. It's end of month. Just might be we've just might had an accumulation just for this day. We'll have to see. But anyway, there's a lot of expiries around this 105, 104.80 up to 104.50. So I'm not expecting, or perhaps we should expect, the price not to stray too far. It could do, of course, but I wouldn't be surprised if we're just still doing this sideways gibberish that we're in at the moment. For me, there's still no real signs that we've got a bottom in play. I won't think about that until I start seeing 105 holding significantly and we start to build on that. Again, though, we have for now perhaps stopped going down, but we did that there in this period, and then we had all that move. So the trend is still in play, but this area is still a big pivot point in terms of where we go next. Right, mate, do you want to take it for a couple?
Yeah, sure. I was going to talk about euro dollar as well, but while you're on there, yeah, okay,
Oh,
don't worry.
no, lost it.
Don't worry. I've got it. Yeah, so just for the intraday, we have tried several times, yeah, that 105.40. In regards to those, just a quick word on the options. If you look at both sides, Ryan as well, and there's a big 104 and a big 106. I think somebody put in a butterfly, and probably when volatility was higher into Trump also. I don't know exactly when they were put on, but it's just the look that it has. Somebody selling the 105 and buying the wings in case it flies away. But anyway, I mean 105.40 already, but then I still, and as Ryan says, we are not out of the woods at all, right? So this, to me, it's rather going to be about the 106 figure 10. Can we get there? Yes, because we are month-end trading, okay, and the models are still showing that we should have some dollar selling. It is going to be a bit of a messy month-end, in my opinion, but what we saw since the start of the week, especially during the European morning hours, is that the euro comes in a bit every morning since the start of the week, but we stopped every time around 105.40. Okay, so get through this 105.40, we may see a bit of an acceleration. 106, very, very possible, I'd say. I'm small positioned in the way of it, just to trade month end. Similarly on the cable, look, we've and we are back on it right now. We are trying to go. Look, this 126.15. Just for the intraday, you know, this could be your level that if we get through, we're going to push a bit higher. I do still think though that on the cable, a bit similar to the euro dollar, the level is rather just above 127 for me, 127.30, 35. So for as long as we stay below, I don't think that this is already reversing, okay? But every reversal starts, of course, with a move higher. But I kind of refuse to call it already a reversal. Where it is coming down, though, and we see the same thing on all the dollars, is at dollar yen. We've had a couple of really heavy sessions here. Yesterday we went through that 153, 40, 60, needed a couple of attempts, but now we're through and we're already below 152. And yeah, that could be just significant for the rest of at least this month and even into the central bank meetings come December, we do see that the JGBs are not moving too much, but the tens in the US are coming down, shorter end as well. That is definitely weighing on the yen. It is really on the interest rate differentials bus. So now we are breaking below. It is significant. Ideally, we should see a retest of that 151.90, 152 and a quarter zone, and then hold and to get lower. And so that is within the possibilities to at least close this month, and then we will see what December will bring. As I said yesterday and on the face show as well, I said everything's possible in the yen. There could be like really big moves coming into year end as well. Do we get 10 big figures lower? I don't know, but we have seen it in August, so why not see it again here, because this is starting to look quite impulsive. Couple of interesting ones on the Aussie and the Kiwi. So we saw a bit of a rebound here on both. But the Aussie is struggling. It's already struggling with 65 the figure. And then you think again about the euro dollar and the cable as well, but it's already struggling here at 65 the figure. Yeah, a bit of a sticky core number. But I kind of start to like this idea about the Aussie Kiwi and the Aussie underperforming the Kiwi in a way, because now we know what happened on the RBNZ. But we do have that weight mean and in the Aussie closer to 2%, which is somewhere in the middle of their range, if I'm correct. So it's struggling here with 65 the figure. Is it going to go over month end? I think it may really go, but that's going to be a dollar thing rather than an Aussie thing. So it may go a little bit slower than the Kiwi. Kiwi, as we have been saying, nowhere near out of the woods, because we're still hanging low compared to where we were just a month ago. Oh no, that's no, sorry, yeah, no, that's early October, like a month and a half ago. But look, there's a bit of an interesting level here. I think if we start to break above 59.05, this could go a little bit higher, and that is what I'm thinking as well, where the Kiwi could outperform the Aussie a bit. It's also a smaller market, so it could go a bit faster than the Aussie if there are some dollars to sell for month end. So I wouldn't be surprised here to see this break 59 figure 5 and go a bit higher. If it caps here and then we're going back down, there's very little that's going to save the Kiwi. But then the Aussie is in the same virtually in the same boat in that case. Really, it's all about those levels then on the majors. Gold is trying to move back through. It's quite funny because gold came down on the expectations and dollar buying, and gold came down on the expectations of that ceasefire. And once we got it, it started to rebound. And again, I'm just going to go on a tighter one here. And again, you look at what what we had overnight, and again, the Asians have been buying gold. So we are through the box. I'm starting to like this box less and less by the day. Still going to leave it here, but I might take it out relatively soon and just watch different levels, like for instance that 2650 here. If we get back above, and don't forget, even the metals have month-end flows. We've seen that many months now. If we get up there, it may be a month-end move. Okay, don't discount month-end moves. On the downside, should be holding anywhere now. Short term 35. 30, 35, 29, 35. If that would not hold, then there's a risk of getting back down to 26.07. Been trading it like I usually do. Re-added yesterday, let some go this morning, and I'm still jobbing it from around the core long, because I think in the longer term, To me, nothing has changed, and even with Trump there, I think over time we could see this one higher. Silver a lot less sexy than the gold. It's just hanging around here, just above the support zone. It is holding, but we are not breaking or making new ground. I'm leaving this one alone right now. Not sure what's happening over there, or what needs to be done, or what's going to happen. We need to get back above 30.90 to really get going. And then, as I mentioned already before, the 31.50-60 zone, even a bit higher, up to 3/4, is really going to have to break to get going. This one, I'm not really trading this one very short term. I still have my long term core, but I don't really want to get involved in short term stuff here. I know that Ali had this interest in the Swissy. Let me get that dollar Swiss back. Okay, Ali. See, yesterday we had like a bit of an up and down move. We are now getting into that zone, the 88 figure a quarter zone. Okay, Ali. So if you're still looking at it, just yeah, keep in mind, and also keep in mind what we saw last year on Swiss into year end. Okay, we may be starting to form similar kind of moves, but it is relatively easy coming down again, in my opinion. I'm planning to go long dollar cat. Dollar cat at 0.87. What is that? Is that 1 divided by or something? No, not even. What is 0.87? Oh, dollar Swissy probably. Yeah, short euro dollar. Yeah, 106 is my big level on the euro. I'm just reading through the levels that Ali is putting in there. 106 is a big level. I think we could actually get there over month end, but everything is to be seen. What are the further downside risks exit, if any, in the euro or cable? You mean levels, main king, or do you mean what the fundamentals are calling for? Be a bit more specific, if you would, please. If you're talking about levels, I think 104.5 is the first one that we need to look at, and then fundamentals. It's the data in Euroland are just not good enough, and if we continue to see those divergence in prints between the economic data in the US and Euroland, then there is a really a market downside risk still for the euro. And in sterling, it's what Ryan already said before as well, talking about retail sales, talking about the consumer. I think there's a bit of a risk in the UK, if the consumer doesn't play ball, and at the same time that Labour government trying to tax the companies and shying away investors. Those are really the big risks in that you see in both euro and sterling, and those risks will be shown over time in the numbers. Okay, but I think we need to make a distinction here and now between what's going to happen month end over Thanksgiving, and then what may happen even in December, and then look at the data going forward. All right, and with that, Mr. Ryan, I give it back over to you.
Thank you very much, mate. Yeah, and this is a comment quickly to Main King in the chat there. If you're trading stuff from fundamentals, okay, then this end of month flows or moves that you see could give you better entries depending on which way you're looking. If we see euro dollar up to 106 and it's driven by month end, then probably your world and your mate is going to be up there waiting to short it, and I'll probably be one of them because the fundamentals still suck for Europe, and they're still good for the US. So the fundamental reasons why the euro is weak will remain well after the month end stuff goes through. So you can use these month ends to maybe get an entry, get a move that then you can hit that plays into your fundamental strategies. Right, anyway, thank you very much, everybody, for coming to the Flow Show. Thank you very much, K-Man, as always. We'll catch you up tomorrow. We'll be here, even though the Yanks will be stuffing their faces. We'll keep you going. Don't worry about that. But anyway, otherwise, catch us on the Face Show a bit later. Have a great day, everybody. We'll see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.